This is basically where we stopped last time. We did solve this one, but just in case, I'm going to remind you of this one. As you remember, last time we were talking about what was the chapter about? Methods expense. That's correct. So we were talking about receivables, right? Start to talk about receivables. And we learned how to recognize them, how to value them. We started doing that. So if you remember, we actually solved that one. So this is more of a warm-up. Here, again, they are asking for the balance in accounts receivable. Yeah, go ahead. Fine. 85% the correct answer. Okay? So again, this is where you're doing what? Accounts receivable. How did we solve it last time? We needed the balance in accounts receivable. They tell you that they have sales on account, 132,000. Cash sales for 54,000. Those are cash sales. We do not care about them. We had collections on account. When you collect money on account, you receive cash. So you debit cash, you credit accounts receivable. So we had a credit to accounts receivable for 84,000. And then we had an account that was written off, and we recovered that account. The recovery of uncollectibles, if you remember, it does not affect accounts receivable because you will be debiting accounts receivable and crediting account receivable. So let's do that and basically convert that to math. Calculate it. The debit side would be a plus, so it's plus 132,000 plus 1,450 minus 84,000 minus 1,450. That will be 48,000. Any questions? Okay. Okay, so it is actually A. Guys, remember, when we use, just to let you know, 64% or 65% correct, that's not good. The exam is in a week or so, so be careful. You have to study the material. Don't wait until the last day. You will not be able to do that. Okay? Whenever you have a question like that, look first at the method that they are using. Which method are they using? Percentage of sales. I'm telling you it will be 2% of sale. The percent of sale will give you what? The adjustment. Remember that. So it will give you the adjustment. In this case, it's 2% of 700,000. That's 14,000. You start with allowance for doubtful accounts. They told you that. It started off with a balance, a credit balance of 1,000. So there was a credit balance of 1,000. The adjustment is always on the credit side because the normal balance for allowance for doubtful accounts is credit. It has a normal credit balance. So the adjustment here, that will give you the ending balance. This is the question. Balance after adjustment. So when you have this one here, it's 14,000. The ending balance will be 15,000. Okay? Any questions? Remember, the percentage of receivables method, the aging method, it will give you the ending balance. The percent of sales will give you the adjustment itself. In all these questions, they will give you one or the other. So they will give you the material. They will give you, like the information that you will need to solve that problem. Basically what you have here, you're missing only one number. You're missing the end one. Okay? Now, as you remember, we said that there are 3 accounting issues associated with receivables. So the accounts receivable, first thing was recognizing them. When do you recognize and how do you record accounts receivable? The second problem was valuing them. How to estimate the value of accounts receivable. Basically, the cash realizable values. And we learned how to calculate under the allowance method. We learned how to calculate it using both percent of sales as well as the percentage of receivables. Okay? The third part is disposing of receivables. Disposing of receivables, this is when the company can sell them. Basically, the company can sell their accounts receivable to another company. Usually they do that when it is either too expensive for them to collect, to keep track of all the accounts receivables and to not just to keep track, to keep trying to collect the money. You see, it's not that easy. It's not that, for example, you send the customer the first invoice and this is it. If they don't pay, you write it off. You have to keep sending notices and warnings, etc., until eventually you either collect the money or you write it off. This could be very costly and time-consuming. In certain cases, companies might, in order to avoid doing that themselves, they sell the accounts receivable. In certain cases, it's the only way of receiving fast cash. So what they do is they sell the debts to another company. Okay? Now the other company, why would they do that? For example, if they sell accounts receivable to a bank, why would the bank accept that? Yes, go on. Accounts receivable have no interest, but they will charge the company, the selling company, a fee. So there are 2 ways of doing that. The first one is called factoring. So a factor is a company, like a bank or financial institute, that will buy those receivables. However, they will charge the company a certain amount, 2%, 3%. This is their benefit. It's 2 to 3% or something like that. So the advantage for those companies is that they will make this fee. Plus, usually these companies, they have specialized departments that are specialized in collecting accounts receivable. So they have collection departments. They have lawyers. They have agents who they can basically keep pestering and keep nagging until they get the money from their customers. Unlike regular companies. So regular companies, they might have one person to do that. These people usually have specialized people. Okay? So the risk for them to have uncollectibles is much lower than the risk of uncollectibles to another company. Why would the company sell their accounts receivable for a lower amount? 97%, for example. Because, first of all, they get their cash immediately. They are not going to wait until they collect the cash from their customers. So they will shorten cash-to-cash cycle. It will become a lot faster to collect their cash. On the other hand, they also have a lower risk of people defaulting because they are selling that. Generally speaking, people, they might not want to default when they are dealing with the bank. So if you owe money to the bank, you will not play around with that. You know that the bank will go after you much more aggressively than a regular company. This is why basically the likelihood that you will default if you owe the money to the bank is much lower. So the factor, which is the financial institute or the bank, they will be benefiting by taking this 3% of those accounts receivables that they buy. Okay? So let's see how this is entered. assume that Henderson Furniture factors 600,000 of receivables to federal factors. Federal factors assesses the service charge of 2% of the amount of receivables sold. The journal entry to record the sale by Henderson Furniture is as follows. 600,000 multiplied by 2, that's 12,000. That's the fee that they will charge. What's the value of the accounts receivable? 600,000. So this is the value of the accounts receivable. This is the amount that will be credited to accounts receivable. How much will the company, Henderson, how much will they actually get in cash? 600,000 minus the 12,000 of fee, right? The fee will be recorded as an expense, right? The fee will be recorded as an expense. So it will be, cash will be debited, 588,000. Service charge expense will be debited, 12,000, and you have accounts receivable will be credited the full amount of 600,000. This is to record the journal. This is how you write the journal entry for factoring. Okay? Any questions about this? Now, there's another way of disposing of accounts receivable, and this is credit card sales. When you buy using your Visa card, if you go to Best Buy and you use your Visa card to buy something there, as far as Best Buy is concerned, they will receive their money as cash. However, it will be the full. It's not going to be the full amount. The net amount will be the full amount minus a certain fee that the Visa card issuer, let's say it's by Chase, they will charge Best Buy a certain fee. Again, they will charge them a certain fee. Usually it's like, it could go from 1% to 6%, it depends. Okay? Even lower than 2%. So it could be a certain value depending on the agreement between the card issuer and the company. Now, the company, this is at the moment that they are recording the revenue. So as soon as the sales revenue is being recognized, the company will immediately debit cash because they are selling the accounts receivable as they occur immediately, basically at the time of the purchase or the sale. So because they are selling that, you're using your card to pay for that amount. You as a customer, you're not, basically you don't deal with, in this case, you will owe the money to your credit card issuer, to your bank, for example. Best Buy receives the money directly from the credit card issuer, minus the fee that we just mentioned here. This is why in certain places when you go and you try to buy something for a very low amount, they will tell you, I'm sorry, but you get the minimum purchase for a credit card, the minimum for a credit card purchase is like $10 or $15. Sometimes this has to do with the agreement between the two. Larger companies like Dunkin' Donuts, McDonald's, etc., you can go and you can buy something for $1, you can use your credit card. Again, this has to do with the agreement. And so, the way to record that transaction is, for example, Anita Ferrari purchases $1,000 of compact discs for her restaurant from Karen Kerr Music, okay? Using her Visa from First Bank card. So it's from First Bank, she's using her Visa card. The company has to pay the bank 3%. This is the charge. It's 3%. As far as the company, the seller, is concerned, how do they enter the journal entry? How do they make, what's the journal entry that they will make?
Cash would be 1,000 minus the 3%.
Okay.
Which is 970.
Okay.
And then it would be a interest expense of $30.
That's not interest. They did not charge them interest, they charged them a fee.
A fee charge.
Okay.
And then it would be a credit
factoring and credit card. With factoring, you're selling existing accounts receivable where you had recognized that revenue a while ago. Okay, so someone owes you money from sales that occurred a week ago, for example. In this case, with credit card purchases, you're recognizing this transfer, this commission, immediately after the sale happened. This is why it's right now you are recognizing the sales revenue. So you have the sales revenue is recognized at this point. This is why you credited $1,000. Okay? So remember, don't get mixed up. When you're using factoring, you will be crediting accounts receivable. When you are using credit card, when it's a credit card sales, this is actually immediately it's sales revenue. Yes.
So if a company uses a credit card method, then they'll never have accounts receivable.
In this case, the company will not have an account receivable. They actually receive the cash from from the bank, not from the customer. So when you go and buy something from Best Buy, you're not actually what you will be paying the bank. The bank is the one who's paying Best Buy. They will pay Best Buy immediately, and then they will charge you the amount that will be between you as a customer and the bank. As far as Best Buy and the bank, are concerned, the money will be transferred basically immediately after clearing, etc., within basically to the bank account of Best Buy minus the service charge. Okay? Lauren.
So, like with a credit card company, they're essentially paying for someone else for like
They will be paying on your behalf. So the credit card company will be paying on your behalf. Now you owe the money. Instead of owing the money to Best Buy, you owe the money to your bank.
But, I mean, these credit card companies, they literally transfer funds to these other
Yes,
businesses.
they will transfer the funds directly from their account to to the seller's account, to Best Buy's account.
So that's made the arrangement of that is pre-made, I guess. It's not like they have to only certain
This is-
certain funds.
This happens at the time before they receive before they get the receivers to their credit card, the swipe cards.
Okay.
Actually, now any one of you guys can buy on the internet and open an account with like Square, I think it's called. Those are small swipe cards that can be attached to your smartphone, iPhone or Android. You can basically, what you do, even Intuit and PayPal, they have all these, they have smart card reader. What you can do is you can just plug it in your phone, swipe an ID, swipe a credit card, and then it will automatically transfer the amount to your account. There will be a charge by PayPal or by Intuit or by any company who's dealing with this, so like 3 to 6%. Again, it depends on the agreement between you and them. The agreement usually has to do with the volume of transactions. So if you are a small deli, you're not going to have the same amount of volume of transactions as you would have for example, as Best Buy would have, or Walmart. This is why Walmart would have a different treatment. And actually there's something called micropayments. Those are payments that are in cents. This is like, for example, Apple. When you buy a song or when you buy something from Apple, there had to be a whole change in agreement so that you would be able to use your credit card in order to make a payment as little as 99 cents. Because usually, before that, there was a minimum amount. Because it would be like, for example, 3% or $1, whichever is higher. Okay? So if you would try to buy something for $1, that will be 3 cents. But the company would be charging you $1, so it's not going to work. This was a whole different story. We're not going to deal with that here. But there's something called micropayments as well. It deals with very, very small amounts that are paid. So when you purchase something as a customer, when you buy something from the company using your credit card, your bank is actually transferring the funds directly to that company for your purchase. They are paying on your behalf, and then they will charge you. They will not charge you a fee. They will charge the seller a fee. Okay? And as you can see, in a lot of gas stations, they will tell you This is why you have, for example, a cash purchase is cheaper than a credit card purchase, right? How many of you drive? Okay, when you go to a gas station, you have two prices. You have credit or cash, right? When it's on credit, it's slightly more expensive. This is because they want to recover this one. They want to recover the fee that they are paying. However, to be honest with you, it doesn't really make any sense. Why is that? Credit cards are more secure to them, to the gas station. They won't have anyone who's going to basically rob them. They don't have cash. It's all directly going to the bank. And if it is cash, the employees might steal from them. If it's in cash, they will have to send someone at the end of the day to deposit the money in the bank. They will have to pay the money as well. So all this is actually more expensive to them when it's in cash and riskier when it's in cash. However, most people are going to use their credit cards and they charge them more. They are making money off of that. Okay? Any questions? So let's do this one. This is a very simple question. Okay. So a question like that is asking you to calculate the impact on net income. Okay? So you have to think about it, how each information will affect net income. The first one is it was a credit card purchase. So as far as you are concerned as a company, this was a sales revenue, right? Sales revenue, what do they do? When sales revenue increases, what happens to net income? Net income also increases, right? Revenues, they increase net income because net income is equal to revenues minus expenses. So you have 5,000, this is plus 5,000. Okay? Now, the cost of goods sold, this is the revenue. The cost of goods sold is an expense, so it's minus 4,000. Then we also have the 3% fee. The 3% fee is always paid immediately. Basically, it's always calculated by multiplying the fee, the percentage, by the sale. So this will be, and then we have the fee here, which is going to be 3% multiplied by 5,000. That's 150. Okay? It's not multiplied by 1,000. It's not by 4,000. It's by the 5,000. Okay? So in this case, it's going to be, the fee is an expense, so it's minus. So the total effect will be plus 5,000 minus 4,000 minus 150. That will be plus 850. Yeah, plus 850. This is the effect on net income. So it will increase net income by $150. By $850. Any questions? Okay. Now we get to notes receivable. Notes receivable are very similar to accounts receivable, except that there's a formal promissory note that indicates the terms of this note. For instance, it will tell the amount. It will tell who issued the amount, the maturity date, on which date it will mature, because there will also be interest. So they will lead to interest. Okay? And sometimes when a customer cannot make the payment on time, so let's say it was 210 net 30. After 30 days, they cannot make the payment. They might contact the company and will tell them, okay, I still want to pay you. I'm not going bankrupt. However, I'm having difficulties in finding enough cash to pay my debt. And then they would make an agreement to convert the account receivable into a note receivable. This would be a formal loan. It's as if the company is lending money to their customers and they will charge them interest for that loan. Okay? So this is one of the things. This is basically like a loan. This is when you settle an account receivable. Whenever there are certain industries where the amounts are very high, so So for such a transaction, accounts receivable may be too risky. As a result, the companies, they would use a note receivable because that's a promissory note. That's an actual document that explains what the loan is. Okay? So let's see how this is done. This is an example of a promissory note, of a note receivable. Remember, a note receivable to one company is if you buy something from, or you take a loan from Best Buy. To Best Buy, this is not receivable. To you, it will be not payable. Okay? So in this case, the payee, this is the person who's actually getting the money, that's the seller, it will be a note receivable. So that's basically the seller. For the maker of the note, this is the person or the company who actually wrote the note, who created the note. This is the person who is promising to pay such an amount at a certain day or after a certain period of time. Okay? So on the promissory note, you would find certain information like, for example, the amount, the maturity date. If you remember from previous chapters, usually interest is paid at the end of, basically at maturity, right? So it will accrue, it will keep accumulating, and then it's paid at maturity. So this one, it indicates the maturity date. You have the payee. Again, you have the interest rate of that one. The amount here, this is what we call the face value. That's the face value or the principal amount of the loan. So the principal, it means this is the amount of the loan. Later on, when we receive cash for that amount, we will credit note receivable, $1,000. We will see in a second how we do that. But there are certain information on the promissory note. It's similar to a check, as you can see, but the check is payable. Now, this one, it's a promise to pay. There are different ways of indicating the maturity date. Sometimes there is a certain specific date. So it would be as if you're saying, I promise to pay you back on December 20th, $1,000. That's a specific date. Sometimes it could be, I promise to pay you back in 3 months. In certain cases, it will be after 15 days or in 60 days. So it depends. There are different ways. There are actually some notes that are on demand. This is as soon as I present you with a note, you must pay me immediately. Okay? So there are different ways. This is the same way that we calculated interest before. You multiply the face value. That's the amount that shows there as 1,000 in the example. So the face value is multiplied by the annual rate. The rate that shows on the note receivable is an annual rate. This is the interest rate per year. So you have then to multiply it by the number of months for the period that you are accruing interest. So for example, if it is 1 month, it would be multiplied by 1/12. If you are accruing interest for 3 months, it will be 3/12. This is the time in year. Okay? So that's an example here of different ways to actually that it is presented. So the first one here, for example, it says 120 days. When it is 120 days, you divide it by the number of days in the year. Okay? Now, a lot of companies, they actually use 365, not 360, but the book wants you to use that 360 for the homework. I think it's simply that the number of, the calculations become very easy, much easier if you're using 360, because 360 is, you can divide it by 12, the number of months. So this is my guess is that this is the only reason. And this is what the book mentions actually, that it makes it easier. So I think as far as you are concerned with the homework, you use 360. So it could be the number of days divided by, so the number of days in that period that you're actually calculating interest for, divided by the number of days in the year. It could be the number of months divided by 12. If it is 1 year, it will be multiplied by 1, because it's 1 over 1. Any questions? Now remember, if the note's payable, if the note receivable is or will mature within 1 year, it will be counted as current asset. There are certain notes receivable that are longer than that. However, at this point, we're doing this. This is, as you can see here, it's for 1 year so far. It's a current asset when it matures within 1 year. Because if it matures after 1 year, you will not be making any payments. You will simply be recording the interest that is accruing. The payment will be made at maturity. There are different, more complicated notes, and we will do that when we study liabilities. This is where a note payable, this is like mortgage. Mortgage is one kind of this where they split up the principal and interest on a monthly payment or something like that. That depends on the agreement. It all depends on the agreement between you and the company who is issuing that, to whom you are issuing that note. Okay, so recognizing the note receivable, this is in the same way basically. So in this case, Calhoun Company wrote a 1,002-month 12% promissory note dated May 1st to settle an open account. It could be a note receivable for cash. You would debit cash, credit. Not receivable, right? Or do you do the opposite? Think about it. You are the company. You're giving them cash, they are giving you a note. What's happening to your cash? Always think about it from an economic, basically think about it. What's happened? You are giving them cash, they are giving you a note. What happens to your cash? It's decreasing. So do you credit it or debit it? You credit cash. In this case, you debit notes receivable. Now, in this example, you are not giving them cash, but they are settling basically their account. So their account receivable will decrease. The company's account receivable will decrease. Instead, there will be a note receivable. So the way the company will record that one, what's happening in this case? The company will have less accounts receivable, more notes receivable. So they will debit notes receivable and credit the account receivable. So when a customer is settling their note, basically it's as if they paid their debt with another debt. This is what's happening. They paid their debt, so we credit accounts receivable with another debt that generates revenue, which is notes receivable. Okay? Valuing notes receivable is also done at cash realizable value in the same way that we learned how to do that for accounts receivable. So you would have the percent of receivable or the percent of sales. Okay? So in this case, we use allowance for doubtful accounts, and we also use bad debts expense to record the estimation of the bad debts or the uncollectibles. Okay? Now, disposing of notes receivable is a little bit different. Notes receivable can be held to maturity. By that, you mean that the company might keep the note receivable until the day it matures. On that day, the company will receive the principal plus all the interest. So it will be principal plus interest. This is given that the note receivable was paid, was honored. Okay? Sometimes, if the company has a note receivable, they can also sell it in the same way as they sell accounts receivable. So it's the same thing. They can sell it, they can keep it until it matures, and then they get principal and interest. In certain cases, the maker of that note receivable might default. When they default, the company will have to make an adjustment. because it's not always that when they default, then they will write off that account. They will convert it actually back to accounts receivable if they have hope that they will receive the money. If they don't have any hope of receiving the money, then that will be a different story. So let's see how this is done. When you talk about honoring notes receivable, this is when the customer who wrote, the maker of the notes receivable, actually pays the interest, pays the principal, that's the face value. This is the original amount of the loan. So they will pay the principal plus interest. Okay, they will pay the face value plus interest. It's called honoring notes receivable. This honoring of notes receivable means that the customer could not pay the note at maturity. Okay? And at this time, this becomes no longer negotiable. Negotiable means that the company will not be able to sell it to someone else. You cannot sell a note receivable where the person defaulted on that. You will have to make an adjustment. So let's see how the journal entries are made. Walter Company lends Highly Co. $10,000 on June 1st, accepting a 5-month, 9% interest note. If Walter presents the note to Highly Co. on November 1st, the maturity date, that's the maturity date, after 5 months. Walter's entry to record the collection is November 1st. What do you write? The company will receive cash, right? What's the amount of cash? It's 10,000 plus 9%. They will receive the face value plus the interest. So it will be 10,000 plus 9% for 5 months. Okay? So cash will be 10,375. This is simply 10,000 notes receivable, which will be credited to notes receivable. The remaining 375, this is interest revenue. Okay? The calculation for the interest is 10,000 multiplied by 9% multiplied by 5/12. Okay? Now keep in mind that this is given that the companies, they prepare their financial statements at the end of December, because the 5,000s were paid within the same period. The 5 months interest, 5 months interest were paid within the same accounting period. In certain cases, it's not, it's paid after. So in this case, in this example, this is the same example. However, let's say that instead of preparing the financial statements after maturity, the company prepares their financial statements at the end of September. That means the maturity date is in the next accounting period. It's the next year. The company will not receive cash. They will not get the payments. However, they earned interest. So you record the earned interest. Is the company going to receive cash? So what account do we debit? So it's not cash that will increase. It's called interest receivable. That would be, so we debit interest receivable and we credit interest revenue. This is for the number of months that were before the end of the year. If this is accrued interest, it's like the accruals that we learned before. So we make an adjusting entry, and it is for 4 months. It started in June. So we have June, July, August, and September. That's 4 months. So the interest that has accrued during those 4 months will be 10,000 multiplied by 9 multiplied by 4/12. That's the interest that has accrued. So it's because the company is not receiving cash, it's going to be debited to interest receivable, credited to interest revenues. Now, when the company receives the payment on November 1st, again here we're assuming that the that this is a continuation of the previous slide, which is to mean the financial statements were prepared September 30th. The company will receive cash, again the same thing, full amount, 10,000 plus interest for 5 months. That would be 10,375. Okay? The company will credit interest, will credit notes receivable 10,000. The 375 in this case is not all revenue because we already recognized $300. It was 300, right? $300 in the previous month. So we don't need to recognize that revenue again. Now it's interest receivable. It's not interest revenue anymore. It's interest receivable. 300. But you still have, you earned interest for 1 more month after the preparation of the financial statements in the previous month. So for the month of October, you have earned 1 month of interest. That would be $75. So if the maturity date is within the accounting period, you don't have interest receivable because you will receive cash before you actually have to adjust for the receivable, for the interest, that accrued interest. If it happens, if the payment or maturity date is after the preparation of the financial statements, if it falls in a different accounting period, you will have to adjust for the accrued interest. So first you recognize the interest that has accrued by debiting interest receivable and crediting interest revenue for that period, and then you will have to still recognize the revenue for the months after, between the preparation of the financial statements and maturity date. So if it were, instead of November 1st, if it were December 1st, you would have 2 months in this case. Okay? And you recognize the receipt of cash. Any questions? One thing, do never make the mistake of adding anything to notes receivable. Notes receivable, when it's credited, it's the face value. It's always at face value. That's the amount of the loan. That's the principal. That's the amount that the company actually lends their customer. This is the amount that you will credit notes receivable. Okay? Any questions? Now companies, they separate between notes receivable and interest because they want to know how much interest they earn basically in difference from notes receivable. They don't want to mess with the actual loan amount. If the customer fails or defaults on the payment on that day, the company would have to make this entry here. What do? They say that, okay, the customer, but in this case, if they still have hope or they still expect the customer to pay them in the future, what they do is they say, okay, the principal and the interest are now the new account receivable. So account receivable would be debited both face value, which was 10,000 plus interest, which is 375. So account receivable will be debited 10,375. Basically what you're saying is that the original loan and the interest that was generated by that loan, now they become the new account receivable of that customer. Okay? And the company will still credit notes receivable 10,000. They would credit interest revenue 375. This is if they expect to receive cash, to receive the payment in the future. On the other hand, if they lost all hope of recovering that money, what do they do? If they now have no more, they don't expect to receive the money anymore. The customer's company went bankrupt, and this is it. They know that they will never get that money. In this case, they will debit allowance for doubtful accounts and credit notes receivable. As you can see, just the face value. In this case, no interest will be calculated. The company is not going to record to recognize any revenue because they did not have any revenues in this case. Okay? They are simply writing off notes received. Any questions? Okay. Now, how are receivables presented on the financial statements? So, on the balance sheet, usually you would have accounts receivable, like we saw before, accounts receivable less allowance for doubtful accounts. Okay? So basically what you need to show, first of all, they are listed usually under deferred assets. And short-term notes receivable are also like the ones that are or will mature within 1 year. They are short. They are listed under current assets. Notes receivable are listed before accounts receivable because they have a stronger form in the form, basically because they have this promissory note. Okay, and you report both the receivable itself and the allowance. Like we said before, you have accounts receivable less allowance for doubtful accounts. Or in certain cases, you can also present it in the same way where you say accounts receivable net of such and such allowance. It means the same thing. Okay? Now on the income statement, the bad debt expense and the service charge expense, those are reported as selling expenses in the operating expenses section. Okay? Interest revenue is usually reported under other revenues and expenses for merchandising companies because that's not their main line of business. It's not like a bank where their main line of business is lending money and earning revenue. Okay? So this is for merchandising companies, usually you would report interest revenue under other revenues and gains. We get to the analysis of the receivables. This is similar to inventory analysis. You remember when we had inventory turnover? Here we have accounts receivable turnover. What we're trying to see is during this year, how many times did the company collect their accounts receivable in total? Okay? So in this example, you have Cisco, they had net sales of 34,000, basically, okay, so 34,526 million. And we have beginning accounts receivable, ending accounts receivable, net. Here they are talking about the net accounting receivable. So we take the average of net accounting receivable by adding the beginning value plus ending value, dividing that by 2. Okay? And then you divide the net credit sales, because again, we're talking about receivables. We don't care about the cash. Cash sales are cash sales. So you divide net credit sales by the average net accounting receivable. This will give you accounts receivable turnover. In this example here, it tells you that this is 7.2 times. That means Cisco during 2011, they collected their accounts receivable 7.2 times. Okay? And then you have another way of actually looking at it as well, which is average collection period in days. This is similar in a way to inventory, basically days in inventory. In this case, what you're looking at, how many days it takes the company to collect all their accounts receivable. So let's say that today, Cisco decides to stop making any sales on accounts. It will take them, on average, 51 days to collect their existing accounts receivable. Here, what you do is you divide days in year, 365, by the accounts receivable turnover. Any questions? Okay. Okay. Remember that whenever you are calculating the total amount of cash that will be received, it will be face value plus interest. This is at maturity, okay? When the note becomes due, it means this is at maturity. Face value is always this original amount, that's Okay? This is how we calculate it. So it will be 5,000 plus 167. This is the amount of cash to be received. A 60-day note receivable dated June 13 has a maturity date of. You're not gonna answer this one. This is simply just don't forget that when you count, don't count the first day. This is similar to when you have the discount period. So August 10, you start counting from August 11, 12, 13, etc. This is how we count it. By the way, how many of you or have ever used Excel? Excel has something that can calculate. You know that with Excel, you can simply do 2 days, 2 dates minus. So one date minus the other date, it will give you how many days. Are you familiar with that? Has anyone tried that one? If you have some time for this, just give me 1 second. For example, if you have here, today is, I don't know, 10. So I did not do that so that you guys would talk. Stop that. And then you have, I don't know, 20th of November. So let's put 20. It doesn't matter. If you put here 20th of November minus, you simply just select those two minus this one, it will give you how many days. That's 23 days. Just enter the date in 2 cells and subtract them. It will tell you how many days. Okay? I don't know if this will ever be useful to you guys, but okay, go ahead and answer it. I'll give you like 10 seconds to do that. No, that's too little. Come on. And actually, as you can see, we have 101%. Don't ask me how. But I will give you a smiley face and a star. That's just to encourage you. Yeah, but 101%, that's even weird. Sometimes you have missing numbers. I don't know how. So this question here, okay, let's do this. This is more interesting. Now that's not good. So in this case, the company, they lend $40,000 on April 1st, accepting a 4-month 9% interest note. Rogers Company prepares financial statements on April 30th. The adjusting entry will be for how many months? 1 month. This is between the date it was signed. This is the signing date. And this is statements. Only 1 month has passed. So the amount, but at least I'm happy that you guys, the majority of you guys, got that we will be recording interest revenue, and this is a good thing. The number, you multiplied it by 4. Remember that this is you do not accrue the 4 months. You only accrue the month that has passed. This is accrued revenues. Interest has accrued only for 1 month. Only 1 month was earned. So you multiply 40,000 multiplied by 9%, and this is multiplied by 1 month. Okay? For some reason, it's not allowing me to write. Anyways, moving on. Okay. So it seems that we lost those ones. Doesn't matter. That's okay. So for question 10, okay? Just take a quick look at it and let's see how we calculate it. This is a very simple thing to calculate. one's manual, so don't worry. Even the smiley face. You got one today. Don't be very happy about it. So in this case, you'll need to calculate accounts receivable turnover. How do you calculate accounts receivable turnover? You divide net credit sales by the average, so net credit sales, you divide it by average net accounts receivable. Okay? So this is 1,600,000 divided by 101 plus 107 over 2. Okay? That would give you 15.4 times. This means that during that year the company was able to collect their accounts receivable 15.4 times, and then to calculate the days and basically the collection days, you would just simply divide 365 by 15.4. Okay? Now we will start with a new chapter. You did not think that you can get away with that, right? You still have 6 minutes. Plus, you still owe me for the first day. I will keep reminding you of that. I will never forget that day. You will have to pay for it one way or another. So, today we'll talk about property, plant, and equipment. They also call them PP&E, plant assets, fixed assets. So they have different names, they are the same. This is land, building, equipment. Okay? And we have started before, we talked about something, basically an interesting concept associated with PP&E. That was depreciation, right? Many of them, they depreciate. And at the end, we will talk quickly about intangible assets. Okay? So plant assets, those are, some of the characteristics of those ones are that they have physical substance. Okay, this is a truck. However, they also have other characteristics. Those are trucks or buildings that are used for business operations. They are not merchandise that the company will sell. So they are not going to be sold to customers. Not now. So it's not that inventory. Ford, as a company, they might have trucks that they use for their own employees, for their own business operations. In this case, it would be considered as equipment. At the same time, they might have trucks, or they have those trucks that they will sell to customers. That's inventory. That's a different thing. So they have to be used in business operations. They cannot be. They are not intended for sale. Eventually, you will dispose of them. So once they are almost dying, you will sell them still. But it's not like that you have them specifically for sale. Okay? And the other thing is that you expect them to serve you for a long period of time. It's not going to be only for a couple of days or for a couple of months. You expect a truck to serve you for several years. This slide simply shows you how important plant assets are, because plant assets, they basically, in many cases for companies, big companies like Caterpillar, for companies like airline companies, they have a lot of equipment. Okay? So a big part of their assets are actually PP&E. Okay? Actually, as you can see here, a company like Microsoft, because they don't manufacture a lot, they have more, it's more in the intellectual property part of it that their assets are. This is why you can see that they have very little or very small property, plant, and equipment portion of their assets. Okay. This we have covered before, so I'm going to go fast over this. Companies, they use the historical cost to record their property, plant, and equipment. So for PP&E, we use historical cost. The cost is not just the purchase price. It's the purchase price plus any additional costs that were associated with acquiring that equipment or that asset until it is ready for its intended use. You buy a building, Okay, or you buy, for example, an office. It's just an empty space. You need to partition it before the company can actually use it as offices. This partitioning would go as part of the cost before this building or this room becomes ready for its intended use as office. Okay? So this is what we mean. If there were any fees, any commissions that were commission fees, any broker fees, taxes, etc., that were associated with the purchase of it, to acquire that asset, then it will be included in the cost. Okay? The first one is land. So land, when you buy a land, when the company purchases a land, they will include in the cost basically all the costs that were associated with preparing it for its intended use. So for example, if the land had some trees and you need to use the land later on just as an empty lot, okay? You would have to cut all these trees. Cutting the trees will be included as part of the cost. If there was some kind of a building that you need to demolish and remove, that will be included in the cost of the land. Any brokerage fees, any lawyers, for example, if the lawyers charge you any amount, this is all included in the cost. Any closing fees, etc. If there were any property taxes that were basically accumulated from the previous owner, and you as a buyer, sometimes the buyer will say, okay, I will accept to pay any pending property taxes or any previous property taxes that are not paid yet. I will pay them. That will be included in the cost. Okay? There's one important thing about land. Land never depreciates. Unlike other property, plant, and equipment assets, land never depreciates because we consider that land will be there forever. So it's not going to be, so this is why we do not depreciate the cost of land. So a Hayes company acquired real estate at a cash cost of $100,000. The property contains an old warehouse that is raised at a net cost of $6,000. That's $7,500. In cost, less $1,500. This is the last one, I promise. Less $1,500 proceeds from salvage material. Additional expenditures are attorney's fees and the real estate broker's commission, $8,000. How do you do that? You start with the cost, you add all the additional costs. So it would look like this here. The cost of the land, I know that I promised it would be the last one, but this is the same as before. So this is the cost of land. This is the amount that the company would be debiting to land. Okay, so when they make the journal entry, it will debit land $115,000. Okay?